Hey everybody, and welcome to the Startup Savant Podcast. I'm your host, Ethan, and this is a show about the stories, challenges, and triumphs of fast-scaling startups and the founders who run them. Our guest on the show today is the founder and CEO of 𝗴𝘂𝘂𝘁, Jesse Randall. 𝗴𝘂𝘂𝘁 is a VC fund with a distinctive twist. They've opened up the opportunity to invest in a venture fund for everyone, not just accredited investors. We're going to get into how they were able to pull that off and a ton more stuff. But before we get started, I want to remind everyone that Startup Savant is a part of Truic, which is a suite of sites dedicated to helping people start and run businesses. StartupSavant.com, of course, is the place where we put everything for founders of scale-focused startups. So go check that out when you need a boost for your biz. All right, now that we've paid the bills, let's get started on the reason we are all here to chat with Jesse Randall of 𝗴𝘂𝘂𝘁. Jesse, welcome to the show.
Ethan, great to be here. Thanks for inviting me on.
Hey, thanks for coming on. This has been a long time coming. I found 𝗴𝘂𝘂𝘁 online like a year and a half ago, and I got excited about it, and I was like, hey, we should have them on the show. And, you know, long story short, it's going to be a terrible story, but long story short, here you are. So I'm not allowed to tell stories anymore, but that's why we brought you on. All right. So we were actually just chatting before the show about something that you did at the very beginning, actually like pre-company, and that was to build a waitlist for 𝗴𝘂𝘂𝘁. Can you give us the story of this waitlist?
Yeah, for sure. It might be good to kind of like touch on where we ended, and then I'll give you context of why we did it and how we did it. I'll try to keep it short.
I'll let you drive.
Yeah, so ultimately we ended up with a wait list of about 60,000 people that we built over the course of about, 9 or 10 months, more or less, officially. Originally we were only supposed to be building that wait list for like 4 to 6 months, and it just ended up getting drawn out for a variety of compliance and, SEC official registration reasons. But it was an amazing outcome, and it was bigger than what we anticipated when we first started the idea of that. So the context is that 𝗴𝘂𝘂𝘁 is a registered fund, and you have to go through this very long, arduous process to actually register the fund with the SEC. It costs $500,000, could take you, what we thought was 4 to 6 months, ended up taking us 11 months to get through this process.
Of course.
And in the meantime, we were like, well, we want to be able to talk about what we're doing. We want people to sign up and to be ready when we get this approval from the SEC so that we can immediately just jumpstart this thing. And so we wanted to build a wait list. And, like most people, you've heard the stories of Robinhood building their massive wait list before they launched and everything. And we thought, we can pull that together. And so we're going through this process with the SEC and getting that rolling. And we decided to build, kind of patchwork together a set of tools that would allow us to bring people in and sign up, and then give them a unique URL that if they shared it, then they could move their way up in the wait list by sharing it with friends and family that actually clicked through and then also signed up on the wait list. It was a great viral effect. But I think that the core inside this maybe, and I didn't mention this to you earlier, is call it the nugget that was at the center of this campaign, is one of the biggest risks I've probably taken in my days building companies. So we had this problem, and I think a lot of founders will relate to this, but 𝗴𝘂𝘂𝘁 is inherently kind of complicated in what we do, how we do it, the context of it. Most people don't really recognize or are well educated on what venture is. And before we started this wait list, if I spent an hour with somebody, they were sold. They knew everything about it. I could walk them through it. It was amazing. But if I only had 60 seconds, I would get a lot of like, oh, that sounds kind of cool. I don't know what you're talking about, kind of looks from people. And, we were going to go direct to consumer, and we're like, okay, if we're going to go direct to consumer, we have to be able to tell this story in 60 seconds or else we're dead. And so we went to some friends of ours that did kind of like new age, like infomercials, but like built for the internet. So you think like Dollar Shave Club and Squatty Potty and Poopery and like a lot of these ones that have become kind of famous. And we were like, well, those are a little edgy, maybe, we're doing venture capital. It's an investment. It's not, spray for the toilet, when you're at your friend's house. Like, it's a little bit of a different category. Can we leverage humor for this? And we ended up working with these guys and this group out of Utah called Creatively. They're incredible. Highly recommended. And we took a big swing. I wouldn't call it exactly scrappy because it was quite expensive. But we spent about 10% of the money that we raised for our pre-seed round just to create this video asset to tell the story. And it was a huge swing. And as we went into it, they gave us 3 options. And it was kind of like a mild, medium, and spicy of like, how edgy do you want to be? And I remember thinking like, oh, well, we better go with the mild one. We don't want to upset anyone, it's an investment. We don't want people to think we're not serious. And I remember they actually they pitched the scripts to us with people like taking different roles, and they actually like role played them. And, they did the mild one. It was like, oh, that was really good. That explains it so much better than I do when I try to walk through it. And then they did a mild one, and they got a laugh out loud from me. I was like, oh, that was actually really good in the middle there. Then they did the spicy one, and I was almost rolling on the ground. It was so good. But it was taking a punch right at the world of venture capital, like making fun of the stereotypical venture capitalist, just like big old white guys that are throwing money around and monkeys throwing darts at dartboards to make investments, and like the whole thing. It was over the top. And I still remember thinking, we left that, and I was thinking before I went in, we should do the mild one. And on the way out, I was like, we've got to do the spicy one, because I don't want a false negative. This became like my beating drum. Like, okay, if we do the mild one and it doesn't work, I will always wonder, if I'd done the spicy one, would it have worked? And so we were like, yeah, no false negatives. If we're doing this, let's go. And we hit it. And that became the core of this whole waitlist campaign. And there was a monkey in it. There was, it was one heck of a production, and it worked. It totally worked. So it was a combination of, technology and good process and nurturing and building community, but it was also, theatrics a little bit, and, creativity and humor, to capture the attention and the imagination of people that were new to the world that we were presenting to them.
Yeah, you're generating interest for something that, the people out there that are like in this world, they may see this opportunity as interesting in and of itself, but there's the long tail of folks out there who aren't like, biting at or chomping at the bit, I think is the term, to like invest their unaccredited dollars into venture. And I'm jumping the gun a little bit on kind of how venture work, or excuse me, how Sweater works. But like, yeah, I think everybody could stand to get a little spicy. I was just at an event, and they had a speaker, and their pitch was that your brand should be loved by many people but hated by some, and that's the idea. They put up the Apple logo and said how many people have feelings about this, and half the crowd raised their hands. And they put up the Dell logo and how many people have feelings about that, and nobody did. And Dell, not that there's anything wrong with Dell, but it's just the brand positioning. So yeah, this idea that you're like, some people may not like this, but I think that's going to make everybody else like it more. Plus, you probably got some media off this. So when you say it worked, what is that? Obviously, it worked to create buzz. It worked to create this 60,000 person wait list. Was there any other effects that it had that you maybe either didn't see coming, or that were just like an outsized win?
Mm-hmm. Yeah, well, I think that when I say that it worked, one of the effects is how well the waitlist converted. We had folks on the waitlist for almost a year before they got to actually come in and participate in the fund itself. And so what worked was that people understood who we were, the problem we were solving, how it related to them, and how it could affect their life, all through a thread of humor, really. And so like you captured their imagination in a way that actually got them to buy into your mission, not just buy in enough to give you an email address, but buy in enough that they hung around and that they continued to stay involved. And ultimately they actually did get involved by putting their money where originally their email was, right? They actually came in and joined us. And so that's what I mean by the way that it worked. Cause like I've worked with lots of groups that put together wait lists, and then they just convert like garbage, and the open rates are terrible. And, people don't remember why they even signed up, but, you contact, well, not now. It's been, over a year since we last had anybody new on it. But at the time, you contact anybody on that wait list and say, hey, do you know who Sweater is and why you joined this wait list? Everybody knew. Everyone remembered. And that was part of the beauty of, that particular video that we made, as well as the name itself, we get asked all the time, where the heck did the name Sweater come from? And the short answer is that the the finance world is old and stodgy and very stoic, and you've got BlackRocks and you have 𝗴𝘂𝗲𝘁𝘁s and you have benchmarks and you have whatever, right? T. Rowe Price. I mean, just like stuff that it's just so boring. I mean, it's like built to be trustworthy. And we were like, we can be trustworthy, but we can also be memorable. And we wanted something that people could relate to. And, it's kind of a typical, marketing rule of thumb that someone has to have 10 to 15 brand exposures before they can recall your brand voluntarily. And for us, it's probably 2 to 4. It's so much faster that people remember us. They know who we are. They know what we're associated with. We are clearly differentiated. So yeah, it's like a combination of all that stuff just made it very effective.
All right, let's go back to the basics. I think it's time we told people very specifically what Sweater is, what Sweater does, and what makes it different than other venture funds out there. So can you give us the breakdown?
Absolutely, yeah. Sweater is a venture capital fund that anyone can participate in. You don't have to be wealthy. You don't have to be well connected. You don't have to have an accreditation status. You don't have to have a rich uncle. Nothing like that. Anyone can download the Sweater app and participate in a professionally managed venture capital fund. So for context, VC funds are the entities that fund the upcoming generation of new technologies and the things that shape the future that we all participate in. We're all using and leveraging venture-backed technologies and companies all the time without even really realizing it. And so typically it's this 1% class that's putting the money in and making the decisions of what gets funded and what doesn't. And we fundamentally believe that everyone should be able to participate in determining who those companies are, as well as benefiting from the growth that those companies produce and the wealth that they produce. So today, anybody can go and download the app. You go in, you can become part of a venture capital fund in, 10 minutes and be able to put in all the information that you need. And you can invest, instead of a $500,000 minimum investment, which is what typical VC funds have, even for small funds. And we make it a $500 investment instead. And so the vast majority of people can afford that. They can get in, and there's neat features like you can set up recurring investments, and every month you can put in another $50 or another $500. We've got a doctor that puts in $2,000 a week and just continues to invest consistently as his cash comes in, and it's just really interesting to see how people leverage it. But it's more than just an investment. And this is one of the things that's so important to Sweater is it's a community. It's a feeling. It's a movement that people can relate to and that they want to be part of their brand, their personal brand, and be associated with it. So we give the example that it's like having courtside seats to the game of venture capital. You don't get to shoot the ball and you don't get to coach the team, but we will give you a tour of the locker room and you get to meet the players and you get to be right there. And it's almost like you're a part owner in the team, right? Because you get benefit of everything that happens. So, we've taken venture capital, we've simplified it, we've lowered the barrier, and we've provided an experience that everyone can really appreciate and participate in.
So these everyday people that are sitting on those courtside seats, I know you said that they can't they're not coaching the team, they're not making the shots, but I'm curious if they are voting with their dollars? Are they in any way having input into what investments are made? Are they replacing and or acting as the general partner or the limited partner or either? And actually, now that we've brought it up, would you mind giving us a quick definition of GP and LP?
Yeah. Let's do a little VC 101.
Let's do it.
I think that would be good for the audience. So for those that maybe aren't as familiar with the way the venture capital world works, a VC fund is made up of a few different layers. So the VC fund itself is run by general partners, which is GP for short, and they throw that around a lot. I'm a GP of a fund. That means that you raised the fund, and it typically means you're the one that is actually investing the money out of the fund into startups. So when a startup wants to raise money from, fund XYZ, they're eventually pitching the GP of that fund who's going to make the final call of whether or not to give them money. So that's like the front end experience that most people think of venture capital as. But there's another layer behind the scenes that GP has to turn around, and they have their own table that they're behind because they raise money from limited partners or LPs who actually invest the money into the fund that makes the fund possible at all. A typical VC fund can only have 99 investors. As a general rule of thumb, there's a few exceptions to that. But this is one of the reasons that the minimum investments for a VC fund are so big, because if you want to raise $100 million fund and you can only have 99 investors, you can run the math and see that like, well, your minimum investment, is got to be pretty high. Even if you have anchor investors that put in $10 million, it's going to be pretty hard to have a minimum investment that's less than $500,000. And if you're talking about a $500 million fund or even bigger, this is where limited partners, just naturally the way the system has been set up, it locks out the everyday person. So limited partners have to be accredited investors for sure. Most usually they are qualified investors, which means that they've got at least 5 million, and by some definitions, more like $25 million of investable capital. And you're talking about pension funds and insurance companies and family offices, all these different types of groups that make up LPs. So in Sweater's context, if we kind of rewind the tape and talk about Sweater's context, if a traditional VC fund can have 99 investors and the typical minimum investment is $500,000, Sweater, we could have, 900,000 investors. We could have, 9 million investors and have the minimum investment be $500 a piece. That's the biggest difference between us. Otherwise, the relationship between us as a fund and the founders that are out there, we're like any other VC fund to the founders. They come to us, they pitch us. We're looking at lots of companies. We have a thesis and we invest and cut checks into the companies that we believe are the highest potential.
So then these people, these everyday people, these non-accredited investors, they are essentially acting as they are funding, these venture deals that you all will be making. So they're kind of acting like an LP. Would that be fairly accurate?
Yeah. So actually, I'm glad you called that out. So in a traditional VC fund, the LPs don't make any investment decisions.
Right.
They're putting their money in the fund and they are giving all of that decision-making power to the GPs who are actually talking to the founders and living day in and day out in talking, and actually assessing opportunities and making investments. The LPs, it's not their full-time job. Their full-time job is to manage an entire portfolio of investments. And this one check to this one fund is just one of dozens, if not, hundreds of things that they're involved in. And they are relying on that GP to make the decision. And it's the same thing for us, and we found it's very similar kind of feeling from everyday people. They don't have the time to go and dig up opportunities. They don't have time to conduct due diligence. They don't have good connections in with people and other VCs that can bring them opportunities. And they want someone else to do it for them professionally. And that's what we are. We are the professionals and we represent you, on the court or, as the coach or whatever. And we use the app to give you that feeling of like you're there, even though you're not actually the one picking and choosing where your dollars go.
Gotcha. That makes sense to me. So then let's talk about the SEC, everyone's favorite topic.
Hey. Love the SEC.
Yeah. This accredited investor rule and qualified investor, these things have been around for like a long time. And it really doesn't seem like the SEC has a whole lot of interest or real reason to kind of like back off these things, at least back off of them easily. And dealing with, federal agencies is just historically not the cleanest, easiest thing that's ever been done. So that's a lot of hoops to jump through to build this business the way that you built it. What made you decide that all of that trouble was worth it?
Well, why was the trouble worth it? That is an interesting question. I mean, I think that,
you could have made a bakery and sold some cookies and that would have been real easy.
Oh yeah. In retrospect, yes, that would have been much easier. Although I don't know, it's got a different type of grind. I don't know if I can make cookies every day. I've actually got some good friends that bought a bakery and did not like their lives for a long time. So lots of respect to people that own bakeries. Let me just make a comment on the SEC and then I'll tell you how we got to this point and like how we decided that this is what we wanted to do. So the SEC, they were created, the SEC as a function was, as an agency was created to help protect regular people. Right. It goes, it goes back 100 years. The laws that specifically govern accreditation and all that kind of stuff, it came out of the Great Depression. It was 1930s, early 1940s. Tons of people got screwed in the Great Depression. There were slimy characters all over the place. They could literally come knock on your door, say, hey, I've got an investment for you, take your money, and then just disappear. And so there weren't a lot of rules in place to help govern, the everyday folks. And 75 years ago, people were generally less educated. They didn't have as much savviness around what it meant to be an investor. There was more inherent trust in society. There are all kinds of things, right? So the SEC and these laws that govern all of this were put in place is ultimately to protect us all, right? And at the time, like maybe that was good, but today it's totally different. The general education level of the populace is much, much higher than it used to be. Access to information is obviously streamlined, and we can get to just about anything. And there are charlatans out there. They're just in a different shape, right? And they play in places where the SEC is not, because if you get caught by the SEC, you're dead, right? I mean, they'll lock you away for a long time. White collar crime is a nasty thing. So in terms of our journey to get here, knowing that the SEC has good intentions and that it's really there to help protect us, I think that there are some deficiencies in that. So my story began on this about 5 years ago. I actually went to go start a regular VC fund, ironically. It was in the Southwest. It was just going to be a small fund. I wanted to make an impact in this place that I'd lived for about 7 or 8 years at the time. I had a lot of passion for the region. And as I started talking to potential LPs, some big checks that could come in and put in those anchor checks and, give me confidence and credibility to be able to pitch others, I was told that I wouldn't be able to invest in my own fund because I was not accredited. And I was like, wait a minute, I'm the guy running the fund. How can I not invest in my own fund? Like, right. That's kind of silly. And I wasn't really that upset about it because I knew about accreditation rules. And there were technically some ways you kind of work your way around it. I could have gotten money in there somehow, but it was a mess. But part of my grad work is in policy. And the number one rule of policy is to research and understand the context that a law was passed in. And that's when I really dug in. I went back to these laws from the 1930s. So there's the 1933 Securities Act, 1940 Investment Company Act, and a couple other ones that are kind of tied in there. And when I dove in, I didn't like the justification of what it said, because it basically says in so many words, if you're not wealthy, then you're probably not that smart. So you need to be protected. And it was just a little bit condescending to me. And I was like, okay, all the good intentions of the world, but like, this is wrong. Like if this includes me, it includes all these other smart people that I know, then this is archaic and it needs to change. And that lit a fire in me, So I dropped the idea of doing a traditional fund and just started plowing down this path. And, there's a lot that happened, but the short answer is it took 2.5 years to finally get an audience with the SEC, with the right people at the SEC. And, we worked it out and we figured it out, but it was by no means an easy path. And, I've been questioned many times why I would spend 2.5 years of my life just to get a meeting. But that's effectively what happened.
Were you funded at that point when you started this digging into why these rules were put in place and starting to try to, get an audience with the SEC? Did you have backing at that point, or was this something that you funded out of your pocket?
Oh, it was definitely out of pocket. I can't tell you how many sideways looks and you're crazies I got over 2.5 years. I mean, I think there was 2 different occasions where I attempted to raise some money, and every time it was like, there's no way that's possible. People have tried this before. The SEC would never change this. There's a reason that, really some condescending stuff. There's a reason that those people aren't allowed in venture. Some real eye openers. It was crazy to see people's attitudes, but no, nobody would give us any money. I'd been out on my own for about 2 years at that point. I was self-sustaining. I had a consulting business, a lead gen business I was doing. And I kept doing those and just kind of like kept the lights on.
Yeah.
I was spending 25 to 40% of my time like working these angles and trying to advance. And the other side, I'm just trying to like work some deals and pay the bills. A relevant part of my story is that I grew up outside of Jackson Hole, Wyoming, like out in the sticks in technically on the Idaho side of the Tetons. I'd look out and see the Grand Tetons out my window every morning.
Nice.
Grew up, chasing cattle, building barbed wire fences, bucking hay bales. That was my life. I have no rich uncle. I have no connections into this space, nothing. Everything that I learned about this, I did from the ground up, and did through research and being smart and finding smart people to help me. I never could have done this alone, ever. So like along that path, there's a reality to it that I am that unaccredited investor. I am that regular person. And so when it came to actually funding this thing. I had no rich uncle that was going to give me $100,000 to like, eke my way through this as I figured it out. Angel investors didn't want to talk to us. I didn't have an Ivy League background. I hadn't sold the company before. I didn't have these things that could have helped me bring in some money. So, I scraped along and figured it out. And along the way, it's probably worth mentioning, we had our 5th child during this process.
Oh, just the 5th.
So like, just the 5th. Yeah. No big deal, right? Had to upgrade to a minivan, the whole thing.
Of course.
So, there was significant like family and like reality pressure there of needing to provide as well. So it definitely wasn't an easy path. It wasn't a simple choice. I put off a lot of career ambitions in order to pursue this. And I'm grateful for where we're at now, but there was sacrifice along the way for sure.
Well, it sounds like you're doing well, and I'm glad that you made it through. And it really seems as though you've opened up this opportunity for millions of people to invest in, an asset class that they did not have access to before you dove into those books and the internet. So thank you. That's as plain as it can get. That's you changed some rules. That's awesome. And without getting into like the nitty gritty details of what those arguments were, or the different subsections of this and the who cares about what's this, when you, with the things that you had with the SEC, is the way that your company is able to operate now. Is this something that you were able to kind of like finagle into pre-existing guidelines, or did you and the SEC have to homebrew like a new path and actually changed rules?
Excellent question. The short answer is we did not change a single rule.
Got it.
You can approach the SEC and advocate for a new framework, and I actually know someone who worked his butt off to do that. And it's a little bit precarious to go that way, because then you're under a huge microscope with the SEC, because they want to make sure it's safe, and it can be hard to do that. But ultimately, every investment vehicle you see out there at some point was brand new. At some point, so the 1940 Investment Company Act was like this big umbrella, and like if you offered any type of investment product in the 1940s, you had to deal with that act, and there were no exemptions. Like you just dealt with it. But eventually, groups would come in and say, hey, we want to do this thing and it's a little different. It's in real estate and we want to pool money and we want to do this thing. Can we have this exemption and can we have these special dynamics? And they would work together to craft it. And then the SEC would say, okay, and off they go. And then the SEC would take that and put it on a shelf. And then anybody could walk into the SEC and say, hey, I want a REIT. Can I do a REIT? Mm-hmm. Or, hey, I want a mutual fund, or hey, I want an ETF, or hey, I want a venture capital fund. All of these things were developed over time, right? And now today, when you go into the SEC, there's dozens of these fund structures that you can pick off the wall. And basically, what we did was our discussion with them was, is there a pre-existing fund structure that would allow us to take money from regular retail investors and invest in the same asset as a venture capital fund, but without being, by legal definition, a traditional venture capital fund the way that they are structured? And the short answer was yes, there's some ways to do that. And they provided us with some options that we assessed, and we came back with the one that we thought was the best fit. And it's called an interval fund. If you want to look it up, it's super exciting. But it was typically used in real estate, which is a different type of illiquid asset, basically. And we just changed the asset and said the illiquid asset we're investing in is early stage venture-backed startups.
That makes sense to me. That's I'm glad that you were able to get creative, and I'm sure you ran many highlighters out of ink by the time you were done with all this. So let me ask, from the investor's point of view, how should the everyday investor think about adding venture to their portfolio, or specifically working with Sweater in their portfolio? Is this like an asset that they should focus on to maximize their returns, or should this be looked at as more of like a diversification move?
Mm-hmm. No, absolutely. So let me give you. This is one of these places where I need to state this is not investment advice.
Of course,
I'm not your advisor. So like take all of this with that grain of salt. And there's a few things that like throughout this I won't be able to state openly. I'm not gonna, when we talk about the Cashmere Fund, I'm not gonna talk about target returns or things like that, right? But what I can do is I can talk about what others do. And we can talk about kind of the status in the market. So the private venture-backed asset class, and venture capital funds, it's been around since the 70s, right? So, and until we came along, there was really only institutional and highly wealthy accredited investors that were able to participate. So over the course of the last 50 years, that has refined into a place where there's a lot of predictability in how the wealthy leverage it in their portfolio strategy. Now, the difference between your portfolio strategy, Ethan, and someone who's worth $50 million is going to be quite different. So, take it with a grain of salt.
Right.
But the biggest institutions out there, they will allocate upwards of 30 to 40% of their portfolio to private assets. And then within the category of private assets, venture will make up anywhere from 5% to 20% of that 30%. Not 20% of 30%, but like 20% of your total portfolio.
Sure.
So, it could be 70% of your private asset portfolio could be in venture capital. Now, I wouldn't recommend that to the everyday person. What we see is it's like, well, if your portfolio is somewhere between 3% and 10%, depending on your risk tolerance, that's probably a good range. And when you start coming down the wealth spectrum and you go from big institutional investors like CalPERS that has hundreds of billions under management, down to the family office that has 50 million, down to the wealthy doctor that has 5 million, down to the regular Joe that's got 50 and has been working his butt off, down to the college student that doesn't have any, and you kind of run all those scenarios. I think that it's part interest and then part diversification. So there's a lot of ways to look at it. And from that perspective, I'll just put one point on it that Sweater has an interesting advantage, is that we're able to invest in a very large portfolio of companies, which makes it risky. Yes, you should only put money into this category if you're willing to lose it. As like first
as
rule.
any
If
category.
you're not willing to, yeah, for sure, any category. Venture especially. I mean, it's very volatile. It's like you either get big wins or you could have complete losses very quickly. So in a traditional, like if you make a single investment, you've got like a 75% chance that's going to be dead zero in 3 to 5 years, right? But if you win and it's like a 99th percentile investment, it could return 100x, 500x your money, right? So that's like one investment. You look at a venture fund that makes 30 investments, and some of that volatility is taken out because of diversification within their own portfolio. So your risk of total loss is pretty low. It's like less than 5%. And then, you've got a 5% chance of 10xing your money. Sweater is even one step further because we're not going to make 25 or 30 investments. We'll end up making 200 or 400 or 600 investments. So that diversification is taken even further along. And yes, you could still definitely lose all your money, but it's a little bit more stable than the rest of the asset class in general.
So I know regular venture funds are kind of like they raise one fund and they have to invest that, all those dollars in a certain amount of time. Is this a situation, is Sweater a situation like that where you're raising, a fund and then investing all of those dollars and then you'll start another fund? Or is this more like kind of like a rolling fund where you're always building up that investment and then, whenever a good opportunity comes along, making investments and kind of just building that through the years?
Yeah, I'm glad that we're framing it like this. So a traditional VC fund, its life cycle is typically take 12 to 18 months to raise all that money from the LPs. And then you've got typically 3 years, maybe as long as 5 years to actually deploy all that money. And then you raise another fund and you go do it all again, right? So each fund has an open and a close, has a fixed amount of money and a fixed number of investments that end up in it. Sweater is different because the fund is evergreen. So you mentioned rolling fund. It's sort of like that, except the classification is a little different because it's a registered fund. So it's evergreen. And in a way, think of it kind of like the way that a mutual fund works, right? It's always open. You can always put money in. We have some liquidity to get money out, which traditional VC funds don't have. But because of that evergreen nature, we have a very different time horizon and a different mentality of how we build a portfolio. So as the money comes in, we're basically aiming to invest that money in a reasonable amount of time right after. So a traditional VC fund will raise all the money and then they have 3 years to deploy all the money. For us, it's like, okay, last quarter we brought in $1 million. So this next quarter we need to deploy $1 million, roughly. It's not quite like that, but as money's coming in, then we're deploying right behind it, more or less. And we've got flexibility on there. We can technically sit on cash for I think it's up to 24 months, but our goal is to deploy it within 120 days more or less, and try to match it so that the money is put to work.
I like that. I like that concept. It's really keeping you on your toes, and making sure that you're always out making the best decisions. Not that you wouldn't anyway, but it seems like another layer of holding your feet to the fire in your investors' best interests. I want to change gears a little bit and come at this from the angle of a startup founder who is looking for venture investment. If I'm a founder of a new company, I'm out looking for a pre-seed or a seed round. I'm not sure exactly which you all focus on, but if I'm looking for that that investment and it fits in your all sweet spot, why do I choose Sweater over a traditional venture firm if I've got a stack of term sheets?
Yeah. Well, these days, if you have a stack of term sheets, you are in a very blessed place.
Oh, yeah. This is why it's a hypothetical.
No, for sure. And I say that as a founder, not as a VC.
Oh, yeah.
Things have changed a lot in the last 6 or 8 months in the VC world. So for context, Sweater typically invests at the seed stage. We can do pre-seed. We've done a few Series A. We've even done a Series B or two. So we have a lot of latitude in how we can deploy capital. From a value add perspective, it's funny, like amongst founders, again, I definitely consider myself a founder. Amongst founders, it's kind of a rolling joke of the value add discussion that you have with every VC, because the list tends to be very similar. I'll bring you great connections. I'll be a great board member. I'll pick up the phone when you need me to. I'll be around when you raise your next round, and they tend to be very similar. And it's all sincere. I don't think anyone's lying about it. No one's trying to like pull the wool over your eyes or anything. It's just kind of ironic because everybody says the same stuff. And legitimately, many VCs have much deeper connections and much more meaningful ones than others. I mean, like you go into Andreessen, and Andreessen has built an incredible network that's, I wouldn't say it's untouchable, but it's best of the best, where if you get an investment from a regional fund, that only operates in, I don't know, Texas, then they may not have much influence outside the sphere of Texas, and their reach is going to be lower, right? So if you were picking between Andreessen and you're picking between this other fund, you'd probably go with Andreessen, not just for the reach, for a variety of reasons, but that's the kind of thing that I know that you're bringing up here. So for Sweater, we feel that we bring a very unique value add to the table, and that is that we have an audience of 40,000 people who have downloaded our app and are a part of our community, and that we have done a very good job of building community and engagement and buy-in around, so that when we make an investment in a company, we can take that company, we can turn around and actually promote it to our base, and they can purchase the product. They can go promote the product through their personal channels. They can champion the product inside the walls of the company they work for. And we can tap into that in a very elevated way. So it's important, I think, as we examine our place and our positioning in the VC world, that we do bring something really unique, and it's all powered by tech. That's the other side of it, right? So, probably, I don't know, we've made 27 investments in the last year. I would assert that about a third of those, we sort of weaseled our way in because of this very thing. They made room at the table for us because they see what we can do today and how this community is going to grow over the next 5 years that will come back and benefit them, because there's aligned interest there. Today we have 40,000 people in the community. We have 5,400 people who have made an investment, and those people have an aligned incentive to help each company be successful because it helps their investment.
Do you have any specific stories where someone or a group of people from that community championed a business that an investment was made in that made a material impact in the operation of that company?
Yeah, for sure. So we're in the middle of one right now that I think is an interesting use case because they have a B2C component and they also have a B2B2C component, where they sell to businesses who then, turn around and sell to their customers. And on that B2B2C side, so the company's called Windley, and they have allergy therapeutics, basically, that you can do at home. So in the US, the standard is if you have hay fever and you want that to go away, you can go see an allergist. They'll test you for it, make sure it's accurate. And then you go in and get a shot every month for 24 months and it will go away. It's expensive. You have to go in every single month. You have to be super consistent. If you miss anything, it's going to throw the whole thing off, But in Europe, they use a different approach. They actually have these little droplets that you self-administer under your tongue. You do it once a week for the same amount of time. You never have to go see the doctor. doctor, they mail it to you, and it's way, way cheaper. And so Windley is bringing that to the US. And these are licensed therapeutics. These are doctors that are allergists, I should say, not therapists. They're allergists that specialize in this. So when they, we can help them take that solution to our base, and anyone with allergies could use it. My sister actually bought it and she loves it. She's just amazed by it. But in a deeper way, they also work with doctors. So they'll work with, say an optometrist. You get that hay fever every year. You happen to be seeing an optometrist. The optometrist is like, hey, looks like you got some nasty allergies. Have you heard of Windley? They can really help you out. And they have a rev share agreement with these doctors to promote the product. And one doctor can bring in $50,000 to $100,000 a year of revenue for Windley. So we're in the middle of organizing all this right now. But just within our own team, we asked around, like, hey, how many doctors are we all connected to? And with our small team, we had connections to over 200 doctors.
Wow.
That we are making introductions to them for. I mean, it's kind of funny when you really start looking around, how many doctors you know. Everybody knows a lot of doctors. And so the next step is going to be going to our base of 5,000 and saying, hey, does anyone have connections to these types of doctors? And as we roll it out, we know that we're going to get thousands and thousands of potential referrals. And what we'll do is organize those and just have a steady drip of introductions to the Windley team as they can handle it, to get these warm intros into doctors that can drive a significant amount of revenue. So sometimes it takes a little while, but it's all driven by tech and the ability for us to communicate and have very, loyal folks that help with that.
Yeah, that built-in network effect. That's something that not everybody can say that they just have access to. So that's a pretty good selling point to me. I'm glad you brought that up. All right, so let's talk about the future. What do you think that the kind of like evolutions or the future of Sweater looks like over the next year or the next couple of years?
Oh yeah, this is where it gets fun. I think maybe I'd say a 5-year vision. I kind of lovingly provide a comparison between us and other software companies to investors, just so that, you get a feeling for how maybe we're a little bit different as a software company. Most software companies can grow incrementally. It's like buying a huge plot of land and building a subdevelopment or a housing development. You sell one house at a time and you build one house at a time, and every house brings revenue, and eventually you fill the whole thing out, right? We're more like building a really big commercial building. It's a different timeline to build the thing. It takes longer to get to revenue. It's you need specialists to do very specialized things to make the building operate correctly. The business model is different, but they're both buildings, right? And it's kind of like, well, yes, they're both buildings, but obviously they're different. And that's kind of the way we think about ourselves, So when we talk about the future, we're building big things that have stair-stepped advantages, that have a huge ability to grow as you get them off the ground. So the 𝗏𝗃𝗃 Fund is the first of many funds. So on one side of the equation, it's very clear that we are going to launch more funds. So when you come into the Sweater app, you'll be able to see the 𝗏𝗃𝗃 Fund that's very, consumer focused. You'll be able to get into a late stage fund. You'll be able to see a climate tech fund. You'll be able to see an impact fund, right? And then you can put your dollars in the effort that you feel is most aligned with who you are. Adding to that, we're actually taking all of our technology and all of our expertise of operating these highly regulated funds and packaging them up so that other groups could come to us and bring their own, and basically build their own fund. They bring their own community, they bring their own deal flow, they bring their own investment committee, and we do everything else for them. And then they list that fund in our community so that our members and their community can come in and participate in that fund and see everything else that's going on. So 5 years from now, we want to have 30 or 40 funds that are inside our ecosystem, both our own funds as well as funds that we're hosting for others. We want to have hundreds of thousands of members. We want to have millions of people in our community that are all adding to this feeling, right? So that, the impact for you, Ethan, when 5 years from now, you're like, hey, I've got this crazy idea and I'm thinking about it. You can come into the Sweater ecosystem. And if you earn an investment from Sweater, you're automatically tapped into an aligned base of people that could bring you your first $250,000 of revenue in 60 days, right? Instead of having to grind through it for like a year, right? Which is the path right now. And it's those types of experiences where when, 5 years from now, we want to be a heavy hitter in the room, right? We'll have 4 or 5 years of full investment traction and I guess track history behind us, right? That people can rely on. And we're going to have all kinds of different types of investors that are involved in this community. But ultimately, you know, like if I'm being, you know, truly true to myself, right? I mean, I'm a founder first. I've founded several companies before this, most of which just didn't perform that well. And it's hard to get a company off the ground. And I'm aligned with founders. I want more founders to be able to successfully build their vision. And the most precarious time to be a founder is between pre-seed and Series A. And to help founders work their way through that faster is ultimately the biggest impact that I want to have on the world and the venture community. And of course, opening up the asset class for all of us regular folks to come around the table is the first step in that. And I care about that a lot too, because I'm also, you know, one of those retail investors. But ultimately, like, we want to help shape the world and shape the future and allow everybody to have a voice in how that takes place.
I think that's a heck of a vision. I love that you are founder focused, that you're founder aligned. That's how we feel here at this show. And I'm stoked to hear it. And you've given me the opportunity to ask you my favorite question, which is, what is your number one piece of advice for those early stage entrepreneurs?
Oh, it's hard to narrow it down to one. You know, it might seem obvious, but having the alignment with yourself that you really want to do and really want to build what you're building is the most important thing. I've tricked myself before into pursuing something thinking that I had passion for it, when really it was more like puppy love, you know, if you compare it to real, like, you know, your regular life and relationships. It's easy to fall in love with an idea at a pretty shallow level. And you can really put yourself and your career and your relationships at risk if you're not truly committed to it. And it's hard to find that commitment when you first start. You don't really know if you're that passionate about it. But there will be a point sometime in that early journey where you will decide whether or not you will stop what you're doing, or if you will double down and keep pursuing it. And it's going to be because you hit something really hard. And that's going to be the defining moment for you, is really knowing whether or not you are going to keep going. And when you get that level of commitment, then nothing can stop you. And it's very rare that you have that at the beginning. Like for me, in my story, you know, it's 2.5 years to get to the SEC. And I actually had 2 points along that journey where I had an opportunity to move on to something else, and to give myself a more stable life with more clarity, you know? I mean, from everybody else's perspective, I was beating my head against a wall because literally everyone said, this is not possible. Why are you spending time on this? And both those were around different co-founders that I had. And, you know, I bought out a co-founder after working together for almost a year. And I gave myself 3 months to achieve a couple of things if I was going to keep going. And I achieved them. And I said, okay, I'm still in this, like, let's keep going. And it happened again a year after that with a different co-founder that I brought on, you know. And at some point you have to find as an individual what is driving you to do what you're going to do. And I would assert that money is the absolutely wrong reason. If you want money, if you want the big win, if you want the fame, those are the most shallow reasons that you can become a founder and have the motivation to build something. Unless you're unless you're a narcissist, maybe then it's built a little deeper, but it's not that deep for me. So you really got to care about what you're doing. And that's what I look for when I talk to founders. We'll go through all the typical business questions and understand the framework and, you know, the market size and your competition and your positioning and all that kind of stuff. But what I really want to know when I'm talking to a founder is I want to find that flame inside you and what makes that flame stay on, because I can tell the difference when a founder has that flame or when they're just building for money. And I don't invest in founders like that.
That was very eloquently stated. And I think if I tried to add anything to that it would be not helpful. So I'm just going to let that sit. Everyone else should probably just listen to that again and then forget that I ever talked. Just listen to that over one more time. All right, but moving on. Hey, you've got a really nice sweater on. Who'da thunk it? Do you give a sweater budget to all your employees?
Yes, actually.
Yes.
We've done it a couple of times. Now, we take sweaters very seriously around here. Matter of fact, we have a whole custom sweater lineup. So if you go on the website, you can actually go to the store and you can find a sweater. You can find the store in the app as well. And oh yeah, we're big on that. It's legit. This one's actually custom made. I don't know if you can see that. It's got a little got my little sweater icon on here. But yeah, we do provide a steady budget for our team to be able to have lots of sweater. We don't call it swag. That's like landfill swag. It's garbage.
Right.
This is like premium stuff. It's really good.
Yeah, I've seen enough photos on your guys' website to know that there is something going on there with those sweaters.
How could we not? I mean, come on, it's like we've got this fantastic, iconic brand opportunity. How could you not have sweaters?
Yeah, that would be a huge missed opportunity, and I don't think I would ever invest if you weren't wearing a nice sweater. So thank you for that.
Yeah, well, I've been told by my board that if they ever catch me in any public setting without a sweater on, that I'll be fired. So I take it seriously.
Don't go anywhere near the South. It's hot down there.
Oh, I know. We're trying to figure that out. We're like, oh God, we got all these friends in Miami and in Houston. We're like, well, maybe we'll do like sweater bikinis or sweater Speedos. And I don't know if that's going to work. We'll figure it out.
All right. I've got one more question for you. And we better do it because I'm having too much fun. Where can people connect with you online, and how can our listeners support Sweater?
Absolutely. Like me personally, you can find me on LinkedIn. I love LinkedIn. I know it's not like the first stop for most people, but I'm very active on LinkedIn and love to connect with new folks and have people follow my content. I publish there every day. It's a combination of startup, I don't know if it's wisdom, but like startup insights of what I've learned along the way, family stuff, endurance sports. I love all that stuff. So if you want to connect with me, I'd love to have you follow along with the journey. Sweater, you can find on all the typical platforms. We try to maintain a positive presence out there. Of course, definitely invite you to go download the app. It's free to download. You can go in and see all the Venture 101 videos and content and get a feel for what the community is like. And all of that, you can do all of that without making an investment and see if you like us or not. And if this category is for you, whether it might be right for you right now, it might be right for you in 2 years, and all of that's fine with us. Like, just come and join the community and have some fun. But overall, I think that we as a company, we're built by people that relate to the everyday person. And it's not technically a hiring requirement, but having your roots in the world of everyday people is something that's important to us. And so when we throw an event in New York, or we have, virtual events that we do, we didn't talk about this, but we throw this massive pitch competition. It's kind of like a combination of like Shark Tank meets America's Got Talent. And we just did one like a month ago here in Boulder.
Is this the Barn Burner?
Yeah, Barn Burner. And it was fantastic. We're doing another one in New York, so we've got all these ways to engage and have a good time. And, we hope they join us for the journey, even if you're not ready to invest.
Awesome. Well, I hope I can get myself out to one of those events and check it out here in the near future. Jesse, this has been so much fun. I really appreciate you coming on and giving us the insight into your business and into the markets that you are so familiar with. And folks, you can find everything we talked about today, all the links, all the videos over at the show notes. Those are going to be at startupsavant.com/podcast. Jesse, thank you.
Oh, thank you. Pleasure to be here. Thanks, Ethan.
All right, that's going to be it for this week's episode of the Startup Savant Podcast. Thanks for listening in. I have just one request before you go, and that is, if you like this show, press on that big old subscribe button. It's right below this video. It's kind of like pill-shaped. It's down there somewhere. Super easy. Yeah, just click that. And thank you. I appreciate you. We will be back next week with another episode, another great conversation, and another inspiring founder. We will see you there. And in the meantime, go build something beautiful.
The Startup Savant Podcast is produced by Truick.